Good afternoon, everyone, and welcome to Landbay's webinar on the UK economy with David Smith. David Smith, as you're probably aware, is the economics editor of the Sunday Times, a role that he's been in since 1989. Prior to that, he worked for other newspapers and also was an economist for Lloyds Bank and Henley Centre Henley Centre for Forecasting. I say he's author of a number of books, not just on the UK economy, but also on China, India, and the New World, obviously the global financial crisis, etc., etc. So I'm delighted to be joined by him. And the format for today is David is going to talk for about 25-30 minutes and run through his thoughts on the UK economy. And then we've got the same time again, 25-30 minutes of questions. If you do have, obviously there's some questions that have been asked that we've prior to the event, but if you do have a question, please just enter it into the Q&A box that should be at the bottom of the screen, and then we'll try and cover as much as we can. So with that, I'll pass over to David.
Good afternoon. It's a great pleasure to be talking to you. This is I don't know what it's like where you are, but there's a bit of spring in the air here in London and the southeast, and I think it's been a long, hard winter. It's been a long, hard winter for the economy. We know we're into our second lockdown within the space of a few weeks. But the daffodils are starting to appear, and I think there is also reason for optimism about the economy and about business. So I don't want this to be a what Boris Johnson would call a gloom fest. I'm going to try and make it as upbeat as possible, which I think is justified. We're all looking for some better news. It's also a risky session for me, given the timing. As you know, we've got the budget next week, and I'll say one or two things about the budget. It's always dangerous to the closer you get to any event, the more risky that any predictions are. So take them with that qualification in mind. So let me get on with the presentation, and I obviously look forward to your questions when I've run through this. I want to talk about how we emerge from this crisis in terms of both the economy and the housing market. As I say, it's been a tough time. It's been an unusual time, an unprecedented time. And I set myself 4 questions to answer. What kind of recession and recovery are we looking to? There was a game that people played trying to attach letters to the shape of recession and recovery. A K, by the way, quite a favorite is the Nike swoosh, but a K is when some bits of the economy go down and continue going down. That's the lower bit of the right-hand side of the K, while others bounce back quite quickly. And I think there is a bit of that, but I'll talk about recession recovery, that budget and our taxes going up. What's the outlook for the housing market? And we've seen extraordinary things happening from the Bank of England, and also quite a frenzied discussion by its standards on whether it should adopt negative interest rates. So I'll talk about whether those are likely to happen and what they would mean. So those 4 broad topics. If we look at what's happened to the economy, what you see there is quite a useful chart, because it incorporates the financial crisis of 2008-9 as well as this episode. And during the global financial crisis, what we saw was a fairly typical but serious recession, 6.5% from peak to trough. GDP fell, and the kind of numbers for the quarterly changes in the size of the economy, quarterly changes in GDP that you might expect in a serious recession, i.e. roughly a 2% fall per quarter, which happened over the most serious phase of the crisis, the end of 2008, early 2009. And now you contrast that with what happened about a year ago, that the economy shrunk by about 5% in the first quarter of the year, and that was entirely due to what happened from mid-March onwards. The first national lockdown began on March the 23rd, but a week, 2 weeks before that, people and businesses had started to take action, had started to take defensive action, stopped going to things, stopped commuting, lots of things cancelled, and so on. So quite a big effect there, but as nothing compared with the fall in the second quarter, when we had the lockdown then for the full month, and that led to a drop in GDP of 19% in that second quarter. Big bounce back then as the economy opened up in the summer, 16% growth in the third quarter, and we even managed to eke out a little bit of growth in the fourth quarter, despite the fact that we had that November lockdown. So it's not the V shape I would have hoped for, but it's not far away from it. I think when we look at it in time, maybe we'll still think of it a slightly wobbly and messy V shape. So, but quite a bounce back has occurred already from that low point. And I think it's important to think that in economic terms, the low point was as long ago as April last year. So 10 months ago. And if you look at what has happened across the economy, consumer-facing services, hospitality, entertainment, physical retailing have all struggled. All other services you see there have done reasonably well, bounced back quite quickly, as you can see, and didn't have as big a recession as sectors like hospitality, and more of a normal recession for those sectors. I mean, parts of the economy did close back in March and April. The housing market closed for a couple of months then, and it didn't in subsequent lockdowns. But you see, if you're in consumer-facing services, that has been the difficult place to be during this period. And I think it's also important to see that the shape of recession, the shape of recovery, has been almost entirely determined by the level of restrictions. When restrictions were the most severe, then the economy shrank. As restrictions were eased, the economy started to grow again. But also that we've got a little bit better at adapting to lockdowns. We saw that particularly in November, where the November fall was a fraction of what happened in March and April of last year. So people and businesses have learned to adapt to lockdowns, and hopefully this one that we're in now is the last one we have to adapt to. So the bounce back was quite logical. Lockdowns 2 and 3, those sequels that, for a long time, I thought that the government would avoid another national lockdown. And I thought that for 2 reasons. One, and you should never believe what politicians said, is that they kept saying there wouldn't be another national lockdown. And the second was that, if you think about the rationale for the first lockdown, which was we got to stop the NHS from being overwhelmed, then I thought that they'd had time to add capacity with the Nightingale hospitals and so on. They could avoid that, but now we know that there wasn't enough additional capacity, particularly additional capacity in the form of people, in the form of medical professionals, as opposed to space. So that's why we had to have lockdowns 2 and 3. And the effect of this is to make that V shape less neat than it might have been, put a temporary brake on recovery. I think if you think about the way certainly the Treasury was thinking about this, they didn't expect a second or third lockdown. People thought 2020 a horrible year, 2021 a pretty smooth run back to recovery. So the first quarter of the year has seen that hasn't happened because of the further lockdown. We've also had a bit of Brexit disruption, which has also interfered with recovery. And the Bank of England, thinks that the economy will shrink by 4% in this current quarter. Some people say less than that, and about a quarter of that fall is due to Brexit disruption. Most of it is due to the third lockdown. We've seen a fall in employment, although things have started to perk up a little bit, as you can see at the end of this chart here. This is one measure of employment, the number of employees on payrolls. It's down by 700,000 to 800,000 compared with pre-pandemic levels. So quite a hit to the labour market. But, you know, as you will know, a lot of that hit has been disguised by the furlough scheme. So, you know, you look at the level of unemployment at the moment, just over 5%, you know, lower than it was even a few years ago. And, you know, there's a lot of disguised unemployment, you know, between 4 and 5 million people on furlough at the moment. And I suppose the big question about this is how many of those people on furlough will find their way back into work when their employer opens up again, and how many of them will become unemployed. Most people think there will be some increase in unemployment. This is one forecast from the National Institute. It's quite similar to the one from the Bank of England, and they see that unemployment will go up to about 7.5% of the workforce, which would be 2.7 million people, about 1 million more than now. A lot of people, I would say, are more optimistic than this and think that the peak will be 6 or 6.5%. And given the nature of the hit to the economy, and given the extent of government support, which so far prevented unemployment going up much, if it can be limited to that, you know, 6 or 7%, that will be a considerable achievement. It will be a much lower peak in unemployment than any we've had after the previous recessions of the past 40 years. You know, typically unemployment has gone into double figures after big recessions. This, as you will know, is in number terms the biggest recession since the Great Frost of 1709. So to come out of that with an unemployment peak of 6 or 7% is pretty good and pretty encouraging, and shows, I suppose, the value of the government's large intervention in the economy to try and prevent this from happening. And prospects for recovery are pretty good. The Bank of England is by no means the most upbeat forecaster. And this is one of the, I don't know if any of you ever study Bank of England monetary policy reports, as they're called now. Used to be called inflation reports, but they use this device called the fan chart. I always say it's a great way of presenting forecasts because you can never be entirely wrong. But the bit to look at is the bold green bit in the middle, and what you've got there is the dip that we're currently seeing in the January-March period, followed by a pretty brisk and robust recovery. So they think the economy will grow by 5% this year once it's shrugged off this lockdown, and by about 7% next year, and we'll get back to pre-pandemic levels sometime in the early part of next year, which will be quite good. I mean, it took us 5 years to bounce back from the recession caused by the global financial crisis. Normally it's 3 years. If it's 3 years this time, that will be a pretty good outcome, pretty good bounce. So strong growth is in prospect, and I think that is an encouraging feature of the outlook. What about the extent to which this has impacted on the public finances? Normally, as you can see, governments borrow a lot during wartime. They have to fund the war effort, and they borrowed quite a lot in the financial crisis. The budget deficit got up to about 10% of GDP, but this time it's approaching 20% of GDP, and that reflects the extraordinary support the government has given, not just the furlough scheme, but others, roughly £300 billion of support to the economy. And so this is the biggest peacetime budget deficit we've ever had. And, going back to August time, when, as I said, the Treasury wasn't expecting further lockdowns, the Chancellor this is the front page of the Sunday Times, late August, and the Treasury was quite happy to brief the kind of things that the Chancellor had in mind for his budget in November. And of course, he couldn't have the budget in November because of the second lockdown. That had to be cancelled, and we're getting the budget next week. But the Treasury was already thinking at that time, how do we pay for all this? How do we bring down the budget deficit? And talking in terms of tax rises, on the grounds that if the Tory party stands for anything, it stands for sound public finances. It's not always a rule that applies, but they having criticised Jeremy Corbyn's irresponsibility before the December 2019 election, then his argument is we can't do the same thing, and we have to show that we're responsible guardians of the public finances. But in that election, December 2019, the Conservatives said that they wouldn't increase any of the three big taxes. The three big taxes accounting for roughly 60% of tax revenues: income tax, VAT, and national insurance. None of those would be increased. Rishi Sunak, made clear in his budget in March last year that he would quite like to increase fuel duty. It would fit in with the government's green agenda, but again, that's problematical. So, and I think you could say, well, nobody expected this in December 2019. You can tear up the manifesto, you can do what you like, but the Conservatives seem to be determined to stick to those manifesto pledges and not tear them up. So so I don't think they're going to come out with things that would go against that manifesto in explicit terms. In explicit terms, I mean, you wouldn't raise the income tax rate. You might do something around the edges by freezing income tax allowances, but not increasing it, because that would break the manifesto pledge. So these are the kind of things that the Chancellor has been talking about, and privately for some time. The triple lock on pensions, you will know that, you raise it by inflation average earnings or 2.5%, whichever gives pensioners a decent increase. Higher rate pension relief has been in Treasury and HMRC sites for a long time. Increased corporation tax from 19 to 24%. I've stuck with the 24% because there were stories at the weekend about him wanting to do it from 19 to 23%. Stories today about 19 to 25%. So 24% is in the middle, and that's what we originally had. And most controversially, and I suppose what would concern you most, is taxing capital gains as income, in line with a report from the Office of Tax Simplification that Rishi Sunak himself commissioned. But I think the guidance we're getting, even on corporation tax, is that there may be hints, but nothing will happen until the autumn. I don't quite know how you delay the corporation tax increase until the autumn, because they apply on on a fiscal year basis. So maybe it's just to set out the possibility of doing it now and then announcing it for sure in the November budget, and he's still planning a November budget for implementation in the following tax year. Lots of concern around, as you will know, about capital gains tax and taxing capital gains as income. We in the Sunday Times have carried a lot of advance protests about this, particularly from entrepreneurs, particularly from Conservative donors and so on. But most of the noise, I have to say, I've heard on this has been from outside rather than inside the Treasury. I haven't heard a lot about an imminent plan to do this from inside the Treasury. They set that hair running back last summer, and I think if it was going to happen, it would happen later. It would happen after a further consultation. So I'm not saying people can necessarily relax about this, and some people aren't relaxing about it. The accountants are busy with, business owners selling businesses if they're planning to do so, and getting in ahead of the budget. So so it's not necessarily an all clear, but I would be surprised if that was to happen. So we'll see what the budget brings, but there would be a big backlash if it was to occur. So I think we'll get more consultation rather than action on that. Now, what about stamp duty? Now, I was talking with your hosts about stamp duty only yesterday, and we were talking about the likelihood of an extension or not. And there was a lot of talk around a 6-week extension. And I think we were suggesting that wouldn't really do much good. But, stories in today's newspapers, lead story in the Times this morning, well sourced. And you don't go for a lead story like that unless you're pretty sure of it. So I think, you know, the idea that the stamp duty cut will be extended until the end of June is one that we should take very seriously. It will obviously prevent the cliff edge at the end of March. It will help, you know, possibly many hundreds of thousands of transactions, which will now fall within the reduced stamp duty net. It will cost the exchequer a bit, you know, maybe up to 2 billion, but we'll see. And you know, there's still a lot of pressure to get rid of stamp duty altogether, you know, including from some of the right of centre think tanks. So, you know, do you move from one cliff edge to another? Do you announce a potential reform of all property taxation? And I think he would like to be a reformer. I don't think this is necessarily the time for radical reform when, you know, you're just moving through a pandemic and the priority is to give more support in that context. But you know, there is an issue about, you know, once you've made a reduction in stamp duty of the sort we've seen, you know, do you accept the risk of a cliff edge later, even if it's later rather than sooner? So I think that is a big issue. It's one we should watch out for pretty closely when the budget happens. We've seen, you know, talking about a third topic, the housing market, you know, a surprisingly strong revival in house prices and in other measures of housing market activity. You know, most of us, when we saw what was happening in March last year, and we saw some of the predictions of what was going to happen to unemployment, you know, immediately, you know, people like the Bank of England, the Office of Budget Responsibility, expecting an immediate rise in unemployment, maybe to 12%, well over 3 million, getting up to 4 million people unemployed. You would have thought those were the very ingredients for a fall in house prices. And the housing market shut down for a couple of months, so we didn't really know what was happening. Instead of which, you've seen this very strong revival in house prices, very strong and surprising revival in house prices. And while, you know, I'm a great believer in the restorative value of tax cuts, this is not all down to stamp duty. I mean, I think, you know, many factors have been in play here. And we've seen, you know, you can take, this is Rightmove's asking price index. I'm always a bit skeptical of asking price indices, but it suggests that, you know, even in February, and even at a time when the expectation was of the stamp duty reduction coming to an end, there were, you know, things were still pretty buoyant in most parts of the country. You know, Greater London less so, and the east of England, but you know, most parts of the country were seeing a pretty strong rise in asking prices then. And you know, one of the things we did collectively during lockdowns was to look at houses. You know, and we you know, Rightmove is one, but there are plenty of other housing websites that people looked at. They looked at that because they had, you know, they had time on their hands, but also looked at that because, you know, they expect to be working from home more than they did before. They want somewhere nicer to work. They don't think they're going to be commuting every day, so maybe they can live a bit further away from work if they're only going in the office 2 days a week or whatever. So, you know, people rethought their lives in a way that, again, you wouldn't necessarily have expected. You know, when a deadly virus was stalking the nation, you know, looking at houses and looking to think about, well, your next house move is not the most obvious thing to do, but plenty of people did it, and this was quite a collective form of behaviour. And we saw that in other places. I mean, if you look at the you know, the pace of house price rises in other parts of the world, then there aren't many places where you see, you know, the kind of reaction we might have expected in the UK. Yeah, Hong Kong, you see there. Spain, maybe for special reasons there. They've had a big coronavirus recession and a nasty, you know, a nasty pandemic. And maybe they're losing expats and so on. Hong Kong, their own political difficulties. But in most parts, you know, house price rises have either stayed reasonably strong or even accelerated. So this is something of a global phenomenon. And, you know, I think one of the most encouraging things in terms of the possible impacts of unemployment on the housing market is what's been happening to mortgage approvals. Mortgage approvals recovered very well, the definite V shape there that you can see. And these are not, people don't go into a house purchase, blind, and lenders don't, as you well know, don't lend without knowing the circumstances of the people they're lending to. They're under, pretty tight regulations about all that. So the people who are borrowing and the people who are lending to them felt pretty confident about their employment prospects post-pandemic. And that, that is an encouraging sign. If you'd seen mortgage approvals remaining very depressed over the course of last year and into this year, you would have thought that the things were still very uncertain and potentially very bleak. Transactions also, bounced back very strongly, monthly transactions bounced back to more than pre-pandemic levels, higher than a year earlier. And again, that's a very strong reaction. I mean, obviously there's a catch-up in there, some of the transactions that would have happened when the market was closed, but nevertheless, another positive sign of a pretty strong market. There was some, I'll run through these very quickly because these are now historic. This is the RICS survey, Royal Institution of Chartered Surveyors. And you can see that when the fear was that stamp duty was going to go back up, there was a little bit of hesitation in among new buyers. You see that on the right there with that balance slipping back below zero. And similarly, people decided it wasn't a great time to put properties on the market because of the possibility and the expectation that stamp duty was going to go back up. All this is now, as I say, quite historic, and that resulted in a little bit of a slowdown in the pace of sales earlier this year. But that is, this is now fairly ancient history, so we shouldn't dwell on that. So what's going to happen in the housing market? I think it is a battle between two forces that we see there, something of a tug of war. On the one side, you've got the traditional dampener on the housing market, which is unemployment, and the possibility of a short-term rise in unemployment as the furlough scheme ends. Furlough scheme is also likely to be extended in the budget, I think, possibly, possibly to the end of June, possibly longer than that. So this again is a delayed reaction. There was a fear of a softening because the stamp duty reduction was coming to an end. But I think if we're going to see the kind of bounce back in the economy, the kind of pent-up demand, the kind of expenditure of the involuntary savings that many households have built up over the past year, then those are not the circumstances in which you would expect to see a weak housing market and weak house prices. They're much more likely to rise, than fall. We've been taken by surprise by the strength of house prices and housing activity over the past year. But I don't think these are the circumstances in which all that is going to tail off very sharply, and we're going to move to a falling market. Many housing market forecasters had a fall in house prices in their expectation for this year on the basis of those first two factors. I think they will be more than outweighed by the positive effect of post-pandemic recovery and a post-pandemic sigh of relief among the population and the release of that pent-up demand. In rental markets, you will know this, the tenant demand is nationally is holding up pretty well. This is again the RICS survey, and again, after that dip, a definite in the spring, a definite V shape there. But there are exceptions, and London is the obvious exception. And there's an interesting backstory to what's been happening in London. If you look at the official measure of employment, and they break it down between different nationalities, different citizenships, what we've seen over the past year is a really sharp fall in the number of EU workers employed in the UK, and in particular in London. Many of those worked in hospitality, and roughly half a million fewer EU workers in the UK at the moment than there were. And one of the big questions, I think, for the rental market is the extent to which those who left because of COVID will come back, will have the settled or pre-settled status and be able to come back. I think that's one of the interesting questions. But I don't know how that, that I don't think that is much of a factor in, particularly in East Anglia and Scotland, which have also been relatively weak in terms of tenant demand. But overall, there has been a big London story if you look at that. What about the Bank of England and negative interest rates? Now, it's worth bearing in mind that bank rate was cut, on the cusp of the handover from Mark Carney to Andrew Bailey as governor. They announced a cut in bank rate of just 0.1% and more QE. I think it was 200 billion then. And this, just to put that in context, when the Bank of England during the financial crisis reduced bank rate to 0.5%, which it did in March 2009, the Bank of England's been around for more than 300 years, since 1694. It's until the winter of 2008-9, bank rate had never been below 2%. So 0.5% was pretty low. And of course, since 2009, it's never been above 2%, it's never been above 1%. So 0.1% is exceptionally low. And the question then becomes, is this low enough? So yeah, mortgage rates have risen a little bit in spite of that, depending on maturity and so on. So even 0.1% bank rate has not prevented some movement in some rates in the market. And the bank has done a huge amount more quantitative easing, principally overwhelmingly buying government bonds. And the debate, it's brought more in the last 12 months than it had done in the previous 10 or 11 years since the policy was first introduced in 2009. So, a massive amount of support for the economy. And the debate at the bank has been whether, if it needs to do more, should it adopt negative interest rates, or should it look to more QE? And in general terms, there are 9 members of the Bank of England's Monetary Policy Committee. The insiders, there are 5 of them, the governor, his deputies and so on, are in general against negative interest rates. The outsiders, the independent members, there are 4 of them, are much more in favour. And when we're talking about negative interest rates, we're talking about a particular measure of interest rates, which is what bank rate is, which is the rate that the Bank of England pays on the deposits that commercial banks have, the reserves they have at the Bank of England. So it doesn't mean that borrowers are going to pay you to borrow, or that you have to pay the bank to put money on deposit there. But it is, regarded as a way of further stimulating the economy. Is it going to happen? I would say probably not. That the insiders will win, and that in any case, as the economy bounces back, then the case for a further action from the Bank of England, the further reaction from the Bank of England, is going to be quite limited. You don't cut interest rates, or for that matter, do more QE in an economy which is growing very strongly, which it expects. But I think the way this issue resolves itself is that interest rates aren't going up for any time soon either, that they will be resolved in essentially keeping rates very low for quite some time. I mean, a rise in interest rates is not even on the Bank of England's horizon at the moment. So I think that is how it will be resolved. And just finally, you've had a preview of this one already. I'm a great believer in informal economic indicators, and there's 2. This one, the skip index, which is my favorite proprietary economic indicator. I've been monitoring this for many years. And it's based on the number of builders' skips in my street. The way it works is that if there are none at all, there's no growth or we're in recession. If there are 2, we're growing in line with what economists would call trend growth. And if there are 4, it's an unsustainable boom. And there have been times, over the past 12 months where we've had 3 or 4 skips in the street. At the moment, there are 2. And I've been combining it with another one, which is, half a mile from here, there's a station car park, railway station car park, which carries commuters into central London. And I've been monitoring that too. And the station car park indicator, I got very excited when it was full during the summer, but that was due to special factors. Mostly it's 20% full. People aren't commuting anymore. So, people are having work done, they're staying more at home, which is a sign of economic strength and growth. And this has been a reliable indicator for many years, but they're not commuting or thinking of commuting for some time to come. And I'll end there. Sorry about the break. I don't know what caused that, but I'm very happy to take your questions. Thank you very much.
Well, thank you very much for that, David. We've got quite a few questions. If we could start, we'll come on to no doubt the budget, but one of obviously the Bank of England has said and expected a sort of coiled spring type recovery. And I just thought, based on that, what's your view on, do we structurally as an economy, do we sort of return to something like normal, with how things might have ended up had this not happened, but we might be a year or 18 months behind? Or is this going to bring forward meaningful structural change, do you think?
Yeah, I thought, when this first happened, I thought that there would be it would be a pretty quick return to where we were. But then the longer it's dragged on, and the more that businesses and others have adapted to what we're all doing at the moment, what a lot of us doing at the moment, working from home. Like, do you need so much business travel? Do you need so many business meetings? The shift online is to a large part irreversible, I think. So there have been some permanent changes. But those are kind of, those are the way and those have implications. All the support businesses that rely on, millions of people being in city centres, for the entire working week, they will be hit by this and they will be affected. I think the bigger, so I think all those will happen. And you think what the pressure was, particularly in London, on public transport, then some of those things aren't necessarily unwelcome. But do we have a kind of, if you think of the things we need to do, which is to break out of the productivity stagnation that we've had since the financial crisis, invest more. The UK has been the lowest investing economy out of the 34 in the OECD for the past 25 years. Are we going to become bigger investors? Are we going to invest more? Do we think about, because of supply chain vulnerability, do we think about manufacturing more in this country than we do importing from other countries? All those things. And I think some of those things will be quite welcome as kind of, wake up calls. The government has shown, when it came to vaccine development, including, quickly getting new vaccine production into use, that when you work with the private sector and you adopt, you really have an intensive effort, then you can achieve quite a lot. But can that be achieved in other sectors? Can can we build that better? I'm a little bit skeptical about that, because I think once this is over, once the government thinks that they've delivered us, they've delivered us from the worst of this pandemic, maybe we have to live with it, maybe we have to have an annual injection and so on. I think there'll be a great sort of sigh of relief and resting back and not necessarily doing all that much. So we'll see what happens. But I would hope it stimulates the kind of thing which would give us a better economy, give us higher productivity growth, give us more value added in the economy, and all those things. But we'll see whether that happens.
Okay, thanks very much. And then another thing, obviously, that a number of questions about is really about the quantitative easing. Obviously, huge amounts of money has been pumped into the economy via quantitative easing, not just in the UK. Obviously, this has happened across obviously a large number of economies, and that then brings the question of inflation. And I think one of your one of the economics writers at one of your rival papers today did talk about how inflation in the 50s and 60s was running low, and then suddenly it sort of takes off when people don't expect it. do you see any sort of risk there at all? Because obviously we've lived with very low inflation for quite a long time now. And you know, the days of inflation above 5% or so of you know, probably 15, 20 years or so.
Yeah, I mean, there is inflation is certainly going to go up, and I think the debate is how much it's going to go up. I mean, if you are you know, the monetarists out there, you know, people like Tim Congdon, who is still around, the kind of veteran monetarist economist, thinks we're going to get 5% or more because of the sheer amount of money creation that governments have been doing. Others, you know, and you know, the more that we get through this with not all that much spare capacity. In other words, you know, you wouldn't expect a lot of inflation to come through if unemployment was sky high. You know, that you know, because you know that dampens down on wage pressure and all those things. But you know, the ingredients are lots of money has been created through QE. We're going to get bottlenecks when all this demand comes on stream, and some of those bottlenecks are in supply chains. We've already seen a substantial rise in commodity prices, which was the factor of the early 70s, which gave us, you know, really high inflation. So I think inflation is going up. You know, most people in the city have convinced themselves that it's only going to go up in the UK to 2% or so. And that what will happen is that the excess money created will go into asset prices rather than into retail prices, you know, the prices of things we consume. But I think it's you know, it's going to be a fine line between that, and I think the debate that's going to emerge quite quickly at the Bank of England, for example, is whether you do what they did after the financial crisis. You know, in 2011, 5%, we had 5% inflation, a little bit more than 5% inflation. That was a combination of a bounce back from the financial crisis and VAT going up to 20%. Now, you know, we could go towards that again. Then they said, well, it's going to come down again, so we won't do anything. This time, you know, if you've got, you know, bank rate at 0.1%, inflation at 5%, it looks as though, you know, they should do something about that. So I think that's going to be a debate. It won't come on immediately, but I think 12, 18 months' time, that is going to be an interesting debate. And the second one is whether they'll ever be able to unwind the QE that they've done. You know, the Federal Reserve, America's central bank, did unwind some of its QE, you know, in the early years of the Trump presidency, before deciding that his trade wars were damaging the US economy enough that they couldn't proceed with that. So, you know, I think it's, you know, one of the lessons, and I hope it has been learned by central banks, is that you know, when the going is good, you should raise interest rates, not aggressively, but, you know, so you've got room to cut. You wouldn't want to go into another recession, and, you know, which is not going to be for a few years' time with bank rate at 0.1%. And you wouldn't want to go into another recession having QE of 900 billion pounds. You'd want to be in a position where if action was needed, you've got the scope to do it. So I would hope they learn that lesson, which I think they didn't do that enough in the wake of the financial crisis.
And then on interest rates, again, something that people asked a lot about is negative interest rates. Now, as you rightly point out, interest rates have been below 1% since the crisis, and for a large part of that time, at 0.5% or lower. And for most of that period, inflation has been above interest rates. So actually, we've been living with real negative interest rates for quite a while, but not obviously nominal. And obviously, I think you know, as you rightly point out, it's unlikely to happen, partly because maybe inflation, but also growth. It's those two things probably mean that it won't happen. But you know, what is obviously they may do, but you know, what would the issues be? You know, actually in terms of the practical issues of actually implementing negative rates, and obviously they are in place within the Eurozone and Japan. Do they work as well? Because obviously the growth in Japan, who's had them for quite a while, I believe, hasn't been particularly high, so it hasn't really provided a stimulus.
No, I mean the argument that you know, those on the MPC make, who favour negative interest rates, is that what's the purpose of QE? The purpose of QE is to ensure that that longer term interest rates are low, and bond yields are low, which they are. So if you want to provide a further stimulus, you have to operate at the short end. And the way it is seen as working is that if at the moment, commercial banks get 0.1% on their reserves at the Bank of England. If it is minus 0.1%, if it's minus 0.5%, and some on the banks say it could go as to minus 0.75%, then they've got a great incentive to get that money out into the economy rather than keeping it on reserve at the Bank of England. So that is the mechanism. But there isn't. I don't think there is an enormous lending constraint at the moment. I mean, there clearly was after the financial crisis, when banks were required and regulated to be on their best behaviour and to be ultra cautious. And what would it mean? The Bank of England has given the banks kind of 6-month notice to say, how would you adapt to negative interest rates? And I think some of them have made it pretty clear they would find it very difficult. They would find it very difficult even to maintain a zero, or some of my savings account earn 0.05%, I think. So does that going to having said you can't give savers negative interest rates, then that is a problem. I mean, one of the things I would also say, and just making the contrast between bank rates and actual rates in the economy. I mean, you all know that even though bank rates stayed at 0.5% for a long time after the financial crisis, it's the start of that period, margins were very high. So typical mortgage rates were still several percentage points above bank rate, and gradually that margin came down. And as my chart showed, it's gone up a bit again since then, but not much. So there is, I think there is a danger that what you get with negative interest rates is a kind of disconnect between the official interest rates set by the Bank of England, which should determine rates throughout the economy, and what lenders and borrowers actually operate with. Because I don't think the lenders would have to respond to a certain extent, but I don't think they'd respond in a knee-jerk way by saying, we don't want to leave any money on deposit at the Bank of England anymore. We've got to lend it all out. So I think it is a quite problematical sort of initiative that they would take. And one of the things I particularly think they should be wary of is because, if anything is we've been taught over the past few years is that once you establish a certain level of interest rates, it's difficult to break away from it. So it's going to be a challenge for the Bank of England to break away from 0.1%. It would also be a challenge to break away from minus 0.5% or whatever it would be. And I just don't think you want to get stuck with negative interest rates. I think it's a Rubicon they shouldn't be crossing. So I side with the bank insiders on this one. But and they're the ones who have to carry the can. They're the ones who are going to be around for years and years, long after the outside members, the independent members, have come and gone.
Yeah, that makes sense. And one other thing we've sort of experienced over the lockdown particularly is just the sheer sort of glut of sort of savings build up. I think it was over the course of last year, around about $250 billion of savings built up, which is around about 4 years equivalent, 4 or 5 years worth sort of equivalent of savings. And obviously a large part of that is, I assume, enforced. There might be an element of cautionary savings up as well, if people are sort of got job uncertainty. But as we sort of obviously in June things lockdown eases, is that going to be part of that sort of bounce back, that coil spring where there's that splurge of cash where people are booking holidays, they're buying cars, they're buying all sorts of things they haven't been, and we have a real sort of consumption boom in the second half of the year?
Yeah, I mean, very much so. And the numbers have been extraordinary. That when normally the saving ratio, the proportion of disposable income a household save is is kind of 5, 6, 7%. In the second quarter of last year, it got to nearly 30%. And even as the economy recovered in the third quarter and spending bounced back, and we had Eat Out to help out and all those things, it remained at 17%, very high. So there are, literally hundreds of billions of involuntary savings around. And this is all because people have not been able to spend on the things they normally spend on: hospitality, entertainment, foreign and domestic holidays, new cars, maybe all those things. So that that is definitely the mechanism for the coiled spring. You don't have to assume that all of it is spent, and some of it is lost forever. Because you as somebody said, you're not, one of the highest component of household spending in the UK is transport. And if you've missed out 6 months of commuting, you're not going to commute twice, just to make up from that. So that that is lost forever. Similarly, there's only a certain amount of entertainment that people can spend money on. Only a certain number of meals you can have out, only a certain number of holidays you can take, and so on. And also, this is not evenly spread. The households that have accumulated the savings tend to be older and better off, rather than young people who've struggled more with unemployment, who've struggled more with loss of income and all those things. And it's the young people that spend, most aggressively. So maybe parents will be providing their kids with a bit more spending money. But the Bank of England's coiled spring does not rely on all of that money. It relies on a fairly modest proportion of those involuntary savings being spent. But even that gives you a big bounce in consumer spending. And I think the numbers we're going to be looking at will be pretty extraordinary. I was looking at them today, that even if you look at what happened in April, June last year, as we open up in April, June this year, then you don't need a massive increase in GDP quarter on quarter to give you a massive year-on-year increase. And that's what gives you, so some of this spectacular bounce back in growth is statistical. It's what statisticians call base effects. Some of it is real. It's the economy getting back on its feet. And I think particularly in the second half, we will see something of a consumer spending boom, which comes back to the inflation point we were making. I think it's hard not to see, higher inflation in that period and beyond. And the question is, how much higher?
Yeah. Well, we've got 5 minutes left, so I thought we'd now move on to sort of, I suppose, taxes and budget. And I suppose the obvious thing is how we're going to pay for it all. And we'll come on to the budget in a second. But one of the things that's been touted, in the press for the entire sort of last 10 months is actually interest rates are so low. Can we not just issue something like war bonds and treat it like a war and almost not raise taxes, and just think, well, we're issuing 50-year bonds and they might be RPI linked, et cetera, and we can take that approach. Is that realistic, or is it just fanciful thinking?
It's not fanciful. I think you have to, you're going to have to distinguish a little bit between how you reduce the deficit and how you fund it. So they're slightly separate things. And at the moment, there hasn't been a difficulty in funding it, not least because the Bank of England's been buying so many gilts through QE. And the other issue, I think, is that as long as official interest rates are relatively low, I think debt interest rate costs will probably remain low. It is only when you get the markets panicking about inflation getting really out of control, interest rates going back to levels that we might have considered low. One member of the Monetary Policy Committee, who's 49, said that he didn't expect to see 5% interest rates, official interest rates, in his lifetime. A bold prediction, but we'll see. But I think the the fact that the cost of borrowing is low is a good thing. The fact that the deficit will come down naturally. Once you take off the emergency support, which the Chancellor will take off as we move beyond the restrictions, move beyond the lockdowns, then the deficit naturally comes down quite substantially. The difference, I think, and the thing that worries the Treasury is the reason you can't rely on that is because, to use your analogy of the war, at the end of the Second World War, government debt was 250% of GDP. It fell for the next, it fell until the 1970s, so that by the 1970s it was down to about 60% of GDP. And part of that fall is because after a war, you can demobilize, you can run down the wartime economy, the government steps back. So you reduce spending naturally, but part of it was due to what's called financial repression, which is that the government could borrow more cheaply than inflation was during that period. So it got the investors in gilts lost out because of inflation, but the government was able to get the debt burden down. The difference this time is that for as long as I can remember, the period from about the middle of this decade onwards was regarded as the beginnings of the dangerous period for government debt, because you had the demographics kicking in a very negative way. An aging population means more spending on pensions, more spending on healthcare, more spending on the other things, long-term care associated with aging, and that's when you got, even when we had. Government debt is roughly 100% of GDP now, even when it was down at 80%, and that was considered to be too high. That's when you got the trajectory taking it up to 260% over the following 50 years from the mid-2020s. So that is why the Treasury is not relaxed about this, and that's why they'll be looking for some medium-term tax increases, I think. And a combination of growing your way out of it, financial repression, and some tax increases to pay for it.
And on that, I know we've got literally a minute left, but in terms of predictions on that and those taxes, like you say, that it looks like they're likely to hit wealth more than income, other than maybe the exception of corporate tax, but taxes on property, taxes on capital gains, that looks to be where that sort of extra tax burden is going. Is that fair to say?
I think so. I mean, what you would hope to see from them would be, reforms which make economic sense, and shaking up property taxation would be one of them, but also over time raise more revenue. And one of those, an example of that on the corporation tax front is, back in the 1980s, Nigel Lawson reformed corporation tax, reduced the rate or removed most allowances, but also made it more of a revenue raiser over the medium and long term, even though at the time business really welcomed the change. So I think it has to be clever, it has to be reform based, and then you raise revenue, as I say, over the medium and longer term when you do it cleverly.
Well, thank you very much for that, David. That was a real, covered all bases pretty much around the economy, and I can't believe that here we are in February 2021 with an hour discussing the economy. And we haven't even mentioned Brexit, so that just we would never.
I did mention it once, John, okay. but just for you, yeah.
But yeah, thank you very much, and thank you everyone for listening in. But yes, thank you very much, David.
Thank you.